We've got PS Jayakumar, MD and CEO at BOB, joining us on the show right now. Mr. Jayakumar, morning. Such a pleasure speaking with you. And firstly, on the onset, congratulations for a good set of numbers. We've seen lower slippages, margin expansion, improved domestic credit growth. What would you say has led to a better quarter for you?
Sorry, could you say that again? I think it's been a good month, this good quarter for us, and I think it's necessary to have few more of these quarters to establish we're well on the path of recovery.
Oh yeah, absolutely. Even we are hoping.
Second question, so to repeat that, I would.
Yeah, absolutely. Even we are hoping that it's going to be a better quarter after better quarter that we're going to see from BOB. But just wanted to understand that what has led to these lower slippages, your margin expansion, improved domestic credit growth as well. What has aided these factors?
I think we have been working on this for some time now. A lot of things had to wait for something or the other to fall in place. For example, we had to hold back our retail growth till we have a collection mechanism in place and make sure that was working. And many of the new programs we launched, we had to test it to make sure they were actually performing as per expectation. As all of those play out, the balance sheet growth starts happening. And there is a lot more opportunity ahead of us as we go forward with the transformation exercise. So it is really a franchise growth that has in turn resulted in better revenue. The operating leverage is obviously very high in our kind of business because all costs are fixed, and so any marginal improvement in the revenue automatically improves everything else. As far as the slippage is concerned, it's been in control this quarter, but we should not underestimate the challenges that are ahead. If I were to take a 12 months kind of outlook, I feel very comfortable because it's not exactly possible to predict when the accounts resolve, although we're pretty much on track to resolution on many of them. So I'm hoping we'll be able to kind of contain the slippages and keep on ticking off on, making more recoveries and thereby keep the upward momentum on place. But recovery is an area that we need to see a couple of quarters of good result. And it's a challenge in the sense there are a number of accounts which are larger in size. It's not exactly possible to time everything precisely in a quarter. But taking a 12 months view, I'm fairly optimistic of the outcome for Bank of Baroda.
Just to clear the air, sir, the ARQ norms or the change in the provisioning norms, are they applicable for the numbers what you've reported for the quarter gone by, or the new RBI audit norms, RBI audit is still on and you will come out with that detailed picture later in coming quarters?
As far as, are you referring to any kind of AQR kind of adjustment, divergence adjustment, is that what you're alluding to? What I want to check with you is that, see, there is the RBI audit and then they come with the divergence report, and then there is a reporting of these numbers provided they break some threshold. As of now, our audit is not concluded. We'll know about it as we enter into mid-December.
Since RBI has changed the guidelines midway this year, do you expect that there could be large divergence, or you've already taken an aggressive write-off and the scope of divergence could not be large? Because you have understanding of your book, sir.
I don't expect. I don't think we should expect we should not expect much of divergence over here. Often there are sometimes interpretation issues, but as you know, we have been recognizing non-performing assets and taking provision coverages fairly aggressively. So I expect on the balance, things should be okay.
Well, that's an important clarification, Mr. Jayakumar, because I think the market is getting surprised on the negative side with the kind of expanded divergence numbers that have come out from some of the other banks. But I want to particularly quiz you, sir, on the slippages picture, because slippages have declined on a quarter-on-quarter basis, and that's been an encouraging sign. However, as far as your stressed asset ratio, which is gross net NPAs, is gross non-performing asset plus recaps assets go, that ratio has remained flat at 14.3. So could you help us understand what the outlook is on slippages and recoveries going forward?
So that number has been fairly sticky, isn't it? And we need to see some reduction coming over there. The part of the reason why that number is sticky is partly because of some telecom related exposures which are moved to restructured assets. couple of bunched up items. But just talking on how how things are looking, see, between the restructured asset and the SMA2 and looking at what what is called as watch list account, we have something around 10,000 crores. So a lot is going to depend upon how we are able to manage the 10,000 crores of amounts that is there. I mean, that's really what it is. But I'm hoping that we will stay to similar kinds of numbers in this quarter as we have been in the last quarter. But what I wanted to emphasize is that whereas in 2 quarters you can kind of give a sense on what's going to happen, on a quarter-to-quarter basis, because of the bunched up nature of certain items, it's not exactly possible to predicate. But leaving everything, I mean, taking everything together, if you have to look at March, or if you look, I think we should be okay. That's really what it is. The other issue is what is going to happen with resolutions and how that is going to play out. That's another important thing over here. To the extent these are large accounts, the steel exposure, the power exposure, our shares in the consortium are relatively small, and we are depending upon the whole consortium process to take it through, and you can form an opinion about how you think these resolutions are going to happen. As far as the smaller accounts are concerned, that's really the area of focus for us, because that's within our control, and so we are working on them. So I would hope that we don't have any surprises next quarter. That said, there is a certain amount of watch list account, and then there is some of them that are lumpy, and we've got to make sure that most of them don't fall into the next quarter. That's really what it is. So there is a degree of volatility over here, but all things considered and taking a little bit more long-term view, it looks like we should be able to come back to a reasonably good position with respect to net NPA and gross NPA.
You just nudged me to my next question then, sir, because you talked about those lumpy accounts, and would you say that sectors like power, like infrastructure, telecom, etc. still continue to be problematic and sticky areas? Because steel seems to be well taken care of for now, but it's a big question mark on these other sectors.
Well, telecom certainly, that we don't have too much of exposure. We have two telecom companies, and we have to watch how those play out in terms of resolution. The rest of the stuff is the usual infrastructure, power, those kinds of accounts are what are there. We have seen some negative movements in agricultural NPA in the last 2 quarters. We are hoping to see some changes to that position and an improvement over here. So, these kind of things are moving around, as you know, pluses and minuses. So let's put it this way: we need to contain the flow in this quarter, and we need to see some improvement in the recovery this quarter, so that we continue to stay on course to the Q2 trajectory. Can I guarantee the outcome? The answer is no. But if you ask me for a 6 months or a 12 months view, I'm very optimistic about the outcomes.
The quarter gone by, have you taken any write-offs in the telecom sector?
No, nothing as yet. We have taken the standard provisions that are required when accounts get restructured. So it is what it is. Our numbers in absolute terms are not very large to fundamentally affect the outcome for us. But all of these things keep adding one to the other, and that really is what it is. So there isn't a single account we have exposures on the balance across all our portfolio of more than 1,800 crores. So that's where it is. So nothing to hurt us in a very significant way, but can keep on nibbling down on the net improvement in the net recovery, the net NPA number.
Which you have reported for the quarter gone by, how many of them are from sectors which currently you were not expecting slippages to happen?
Well, by and large, it's the same trend. It's a continuing trend. I don't think. It's a continuing trend. There may be some slippages with respect to the SME portfolio, which is fairly consistent with what we've been having in the previous quarter. So no surprises over there. Overall, it's just a continuing momentum with respect to these accounts. The thing I would toss around and look at it slightly differently is in the final analysis, what is going to be the provision numbers that we have to take, what is going to be the net recovery numbers we are going to get. I think we have to start focusing on that, because at the end of the day there is only so much in SMA2 and restructured asset. But what we now need to do is to understand finally what it will cost us, and so that's the other area that we are working upon.
Just quantify what's your exposure to both the lists of RBI, IBC accounts, and how much do you still need to provide for?
Oh, sure. Sure. So in the first list, we had about 7,400 or 7,700 crores, I think, of which our provision coverage is around 53 or 50, is between 53 and 55%. And in the second list, we have 4,800 crores of exposure. There, our coverage is probably in the 15-20% level. Net, I think our total number of additional provisions after adjusting for whatever we have provided till today is about 1,000 crores, assuming everything in the list 2 slips into NCLT.
Mr. Jayakumar, you know, a little while back to my question, you had said that you do plan to bring your gross NPAs and your net NPAs down to a respectable level. You've just highlighted, you know, some of the chunky accounts that you may have exposure to as part of the list put out by the RBI. What would that respectable number be? If I were to ask you from a 6 to 8 month perspective, because that's, you know, where the market is focused on, how much lower can you bring your gross NPAs and net NPAs by?
Okay, let me tell you. You know, I somehow don't like to focus on this gross NPA. I don't think it represents anything. Indeed, it can create a perverse incentive to put on assets which may be of low quality. So we really don't look at that. We just put the right quality of assets and manage our capital adequacy and focus on increasing the operating income, which then gives us the organic capital to pay for the NPA. What we are focused on is absolute net NPA number and where that settles down. Today it's around 19,000 crores. The comfort number for us to be in a safe harbor is around 12,000 crores. At that number, together with the growth that we are estimating, our net NPA ratio should be in the 2.5% level. That's what we are working to.
Jayakumar, I have to talk to you about the government capital.
And I think we have a reasonable. Yeah. Please.
No, please finish your point, sir.
You want me to comment on it?
Yeah, I'm just coming to that. Here on my question first. Just wanted to know what is it that you're, you know, expecting by way of government capital infusion as direct funds or as part of the PSU Bank recapitalization plan, and more importantly, what is the structure of the PSU Bank recap bonds that you do expect from the government?
Okay, let me try to answer your question in two different ways. One is that let's for the time being assume there is no recapitalization initiative on the part of the government. Where does this take us through? I think we have the capital ability to absorb the losses and stay well meet the regulatory requirement on a CET1, which is the core capital of the bank. We would be going in for a QIP, but that's primarily to fund the growth opportunities. That's one. Second, we are still working out on the impact of Ind AS as it relates to creating additional provisions. The position is not as clear as yet, and there are a lot of opportunities for us to reduce some of the risk with respect to the Ind AS accounting. So that's an open item. So then the third question is, what is that we like to grow and how much we'd like to grow? That takes us back to the growth capital issue. So on the balance, I would say to you that our position that we don't need any government funding to secure and meet the regulatory capital in the context of the balance sheet remains intact. Two, we are definitely going in for the further capital rise, both with respect to AT1 and QIP. We have to time it. And three, we would certainly take the opportunity for further infusion of capital from the government. And the exact quantum of it, we are still in the process of working out. I think we have time till the last end of December to submit our recommendations to the government after taking board approval. So the process is on. But the principal position that I have that we don't need any bailout still remains strongly there.
Mr. Jayakumar, just last couple of questions. So one is, you know, on this recap plan, how much can this really help in, you know, leading to that credit growth that one is anticipating? You know, do you really think that there was a significant capital crunch for banks such as yourself? I know that there are some other banks which are more troubled. And how much of this recap plan can actually start off or resolve the demand problem? Do you think demand is going to come back and that's going to help the credit growth cycle?
Well, I would put it this way, that there is clearly an opportunity for any bank to grow its balance sheet at this point of time with good quality asset. It's true for us. and it's true for anybody else, many others as well. But is that increasing the total pie of credit to the overall sector? That's also dependent a lot on how the broader macroeconomic performs. Then there is of course this large plan for investments in infrastructure and a lot of push out with respect to MSME and others, and the belief that the capex cycle will restart again. So if you take a kind of a 2 to 3 years view, which is what we should take when we're looking at capital and fundraising, it seems to me that there is enough opportunity to grow for all of us. But within the context of Bank of Baroda, I think we have enough opportunity with both our existing customers. There are many segments we're grossly underrepresented. We're putting the right kind of products and processes to have a go at these segments, and so our plan for growth is kind of from the 75% or 80% of the growth is independent of the macroeconomic and based on being able to do more with our customers. That's really the thought process around it. But I think we have to assume with 8% consistent growth in the economy, there would be a definite need for increase in credit. And some of the things like GST and others, much as it may have created some pain in the short term, are also going to encourage a lot of flow-based lending, as there is more transparent data available with respect to those customers. So I think we can expect some positive momentum here.
So Jayakumar, I know it's been a long day for you, and you've been extremely...
In the past, I would always put my head out.
Yes, please. We want you to put your head out and make the next prediction.
No, I said in the past we would have put our head up and said this is, and given the number, but now I'm just trying to be a little bit more circumspect about it and straying to a broader theme, a broader outlook, and looking at it for a much more reasonable time, so that what we say is consistent with the outcome. But if you ask me what my mood is and what the mood in Bank of Baroda is, it's extremely upbeat.
If you have to put your head out, you would say that you're extremely upbeat, right?
Yeah, but you know what I'm saying. We are doing a lot of things on the restructuring, on lots of product changes, program changes. See, the point is the press and others don't focus on it, but unless you get the organization re-engineered, you make sure people have been trained better, and all of those good stuff happen, technology, data quality, analytics, etc., the long-term growth is not going to happen. So whereas you focus on a quarter-to-quarter growth, and it's important, we focus on what are the changes that we need to achieve a secular growth and build the core competencies. So the approach with respect to optimism for me is based on the second thing, which is the transformation exercise is actually going as per plan.
I will leave it at that. We really appreciate you joining us, on this very extended discussion, taking us through all the details on how business is shaping up for Bank of Baroda. I really appreciate your time, sir.
It's a pleasure. Thank you very much.
Thank you very much. Okay, with that, it's time out on the market as well as first trades. You can see the stock of Bank of Baroda not doing a whole lot, 0.5% higher in the session. That's the case with the markets too. And with that, it's a wrap on this edition of the show. From Nikunj, Aisha and myself, thanks very much for watching.